It's a topic for us here.
Yeah, that's great. Well, welcome to the News of the Money World, everyone. Thanks for joining us. It's great to have you here. My name's
Hi,
Darcy
everyone.
Ungaro, and I'm with Rupert Carline, and we were just having a little bit of a chat that we let you in on around bonds, equities. So if you hear us talking about the equity markets, the share markets, shares, we'll put that in the equities category. If you hear us talking about bonds, yields, stuff like that, we're talking about bonds. So we're talking about the death of the 60-40 portfolio, question mark. Is the and we'll define what that means as we go through this. So perhaps Rupert, actually, maybe we'll just start with your best definition of what does it mean to invest in equities and what does it mean when we're investing in bonds? Do you want to break that down for us?
Cool. So equities, or in to speak, growth assets, what you invest in. To basically, that means you're investing in the global stock markets. The other big asset that people invest in are what we call bonds, fixed interest, or in to speak, income assets. And so, well, you invest in them for different reasons. So equities, they tend to have capital growth because they generally you're investing in companies. The companies grow their revenues, they grow their earnings, they grow their dividends. And so that's really what you're looking for to drive capital growth against a portfolio. On the flip side, you have bonds. Bonds or fixed income products you buy, and you buy them because you're expecting a fixed rate of return through that period. And then you're going to buy it. So I'm going to spend $100 and buy my bond. I'm going to earn a 6% return on that bond on the whole way through. So I'm kind of guaranteed my 6%. And then at the end, I'll get my $100 back, exactly the same as if I loan a friend. The big difference is that a fixed is an equity, so a share or growth asset, your return is not guaranteed. And so the value of your capital, which is the value that you paid for the share, will move, and the dividend that comes out of that as well by definition will change depending on the performance of the company. And because the performance of the company is driven by so many different things, including an economic cycle, what you find is that the value of equities are pretty volatile, lots and lots of ups and downs, whereas the value of bonds, it can be pretty steady, right? The only thing that really changes it is when there is a big shift in interest rates, like at the moment that we're going through.
Okay, and we'll dig into that a little bit more. But you might be wondering if you're listening in, you might be wondering, well, why is this relevant for me? I'm not really excited by these stupid, boring bonds thing. I don't want to put some money in and get 1.5% back for 20 years. That sounds so dull. But I'm totally into 10% average rate of return for the long term. I'm a high risk investor. Equities all the way, baby, right? So why is it that it's kind of been recommended, and it's not necessarily a specific recommended or a golden rule of thumb, but you hear this term 60-40 a lot, and obviously that applies to 60% of your portfolio allocated towards the equities. So that's the stake of ownership in a bunch of different companies, and then 40% of what you're investing in is effectively being lent to governments, corporations, stuff like that, and they have to return that back to you with interest. So like you say, Rupert, one is you're becoming a partner in the business and the growth and the success story. The other one, you're basically just lending them some money and hope, well, you will get paid back, subject to the creditworthiness, etc. Not always. That's right. So sometimes it's not safe. Sometimes it is safe, but it's kind of like there's pros and cons in each one. But why the 60-40 blend? Like, do you have any sort of hint as to why that magical ratio seems to have come about?
Yeah. So look, portfolio theory, which is where the 60-40 blend comes from, is all about how do you maximize your return and minimize your risk at the same time. And so when you go through that, what does that mean from a portfolio theory perspective? So the blend of 60% and 40%, that was seen for a long time to be that optimal risk, that optimal level. And the reason for that, there's a small thing called correlations. Correlation, so the level of correlation is how closely one asset moves in line with another asset. So if, say, for example, the value of bread moves in line with the value of wheat, then that's 100% correlated, which is a correlation value of 1. On the flip side, though, bread and ice have got nothing to do with each other. There is zero correlation, so it's a correlation of 0. Whereas sometimes you have other things, right? So you go, the price of bread and Rupert's hunger level move in completely opposite directions. So therefore we call that negative correlation. And the beauty about negative correlation is, from an investment perspective, is when one thing goes down, the other thing goes up. And that's when we start to think about constructing the optimal portfolio, because we're building something where we can actually somewhat smooth out the ups and downs of returns over the long run. And so bonds and equities, they traditionally have been negatively correlated. They've got a negative correlation of about 0.2, 0.3. So traditionally what has happened is whenever there is an increase in the stock market, that means the economy is going really well. Things are kind of working really strongly for everyone. So interest rates rise, the value of bonds fall. So that means that that means that they're negative correlated. On the flip side, when things in the economy start to turn to shit, what that means, the value of your equities are falling, because the earnings numbers and the company profits that drive the value of those shares will fall. But central banks will come in and move to lower interest rates, which will mean the value of your bonds increase. And so 60-40 was always seen to be around about the rough number where kind of the correlation benefits were maximized, so that you kind of sat on the efficient frontier of maximizing the return for an appropriate level of risk.
Got it. It's quite cool. While you were talking, I was just trying to find a really simple graph of the efficient frontier. But if you can effectively imagine a graph where you can kind of plot the movement of returns with risk, that's kind of the idea, is that we're trying to blend these two different asset types together just the right proportion, so that you're maximizing your return for the given level of risk that you're expecting, or that you're comfortable with taking. And that's what we call the efficient frontier. So when we kind of think about these rules of thumb, it's really easy, I guess, to get stuck into the rule of thumb without actually thinking through the logic. And when we have an environment like what we've had over the last 40 years, let's say, where interest rates have pretty much steadily been on the decline, that obviously is very bullish for equities. Lower interest rate environment, cheaper source of funding, think of it like that, pushes the value of our equities up. But as the interest rates in the market go up, then that makes as the interest rate in the market goes down, that makes the bond value. Oh, man, I always get lost with this. Help me out.
Interest rates fall, bond values go up. And that's because the reason for that is that fundamentally it's a net present value of a set of cash flows. And if you're using a lower discount rate, which is a lower interest rate to kind of value those cash flows, then the value will always go up. It's like what we've been saying for the last year and a half around why all of our long dated tech stocks are falling, because the value of their future cash flows is significantly less in a higher interest rate environment.
Got it. So now when we look at this environment that we're in today, where interest rates have been so low for probably a little bit too long, now they're going up a little bit. There's obviously infinite amount that it can go up, especially when you look at where they've come from. They got a long way to go up if they really wanted to. And there's only so much that they can go down. And that's why there's this question of, hey, is this really the end of having this negative correlation going on between stocks and bonds? Because now we've got interest rates going up, which could actually cause problems on both sides at the same time. The correlation maybe only lasted for a season. Is that kind of the argument with the death of the 60-40?
Well, I think there's two arguments. One is definitely that argument about correlations. Though I think we don't like to admit this, but we have actually seen interest rates can also go negative. And I think that's a really interesting one, right? Where you kind of look at, the German bond yield has been trading negative for kind of probably 2 of the last 3 years, for example. And so I kind of challenge that assumption about how low can interest rates go. But yeah, fundamentally that is the answer: is is it now impossible to get any capital value appreciation on bonds? But I think the other big argument for me is the opportunity cost of owning bonds is also a whole lot bigger. over the last 10 years, you've kind of struggled, even during the really good times, to get more than 4% yield on a bond portfolio. Whereas historically, that number has been kind of more like 6 to 8%. And so you've not only have you got it that you're losing the potential for capital appreciation and the correlation starting to break down, but actually the opportunity cost of owning bonds has been so high over the last 10, 15 years.
Yeah. Okay. So is it then that the correlation, like that negative correlation that you mentioned before, is it then that was true for a season, and maybe right now we're at a transitional period? Is that kind of where you're going with that?
Yeah, well, that's what I don't know. I mean, I think I've said this before. I'm happy to. I do not believe that we will ever get out of a low interest rate world without a significant amount of pain. And I think it's kind of, I look at Japan, I look at some of the other experiences. I fear that we are stuck in this low interest rate environment for a very, very long time. So yeah, but it is kind of interesting, right? Where you look at where we are now, what's potentially going to happen. It's just the opportunity cost argument that I was talking about, where actually, if we can't get out of this low bond and low yield environment, the opportunity cost of bonds is always going to be there. And then you've got the capital argument, which also disappears. I think I do find it interesting because, yeah, it's whether we believe that the kind of what we think the long-term returns on equities are going to be, and are they sustainable? Definitely not the last 10 years. They're not sustainable. But what is that opportunity cost? And then you kind of come to the second question, which is, can people afford to wear that opportunity cost, right? I'm retiring. I hope one day I want to be able to put my money to work. Actually, putting 40% of my money earning 2%, or 40% of my money earning 8%, or even 6%, that is a humongous difference in the amount that I've got to put away. And so, yeah, so to me, it's the opportunity cost argument, which is so strong. And so, yeah, I think if interest rates do not, or if we cannot get interest rates back to a normal level, then it's going to be really hard to see kind of that 60-40 coming back again.
Yeah, yeah. And I guess a certain amount of this is also protecting us from the downside, right? So it's the cushioning ability of having that hopefully negative correlation. You've got a little bit of a impedance when you're moving too fast, a little bit of a cushioning when you're falling back. Are there substitutes then? Like, do you think that there could be? I've got a few ideas on what I'd like to substitute it with, but what do you think are the mainstream sort of substitutes that people are comfortable with?
And I think that's also really interesting, right? Because I do think that you are starting to see a number of alternative asset classes appear, which can deliver the components of that income, the income components of your portfolio, right? And so if I kind of go things like infrastructure, things like property, these are asset classes which have traditionally delivered really good income. And then these are asset classes which historically, kind of GFC exempt, have performed really well through a downturn. And so what you've also seen over the last 15, 20 years is the emergence of and the reduction in cost and increase in access of all these new asset classes, which actually means that you've now got a whole lot more options. And I think that's what's really exciting, right? Because, yeah, there's an argument in KiwiSaver land at the moment of property. Certain fund managers are arguing that actually the property should go into their income allocation. Infrastructure, it's the same, right? I think, but it's about looking for assets which have got the characteristics of safe assets that deliver income, and going, actually, can I use some of those assets to replace the core income components of my portfolio?
Yeah, makes sense, right? Because you've got the infrastructure, you've got property. Like there's yield coming off this. Obviously, there's still some positive correlation with traditional stocks, I would imagine, with property, especially because of the interest rate piece. But I guess there's also commodities, including, like, I would put probably even currencies like Bitcoin potentially in that category. They're very, very different. Like, they're not spinning off income. But my big question mark that I have is, I wonder if bonds are starting to transition from a so-called safe haven status into a speculative category. And I wonder if some of the speculative categories are becoming more safe havens, specifically Bitcoin. What do you think about that?
I'll address your first question first around the speculative nature of bonds, and I 100% agree. And I think there were a lot of people that saw this in 2020 with the COVID crisis, right? Different types of bonds react in different ways to a crisis. And when we kind of talk about them as being fixed income or fixed interest assets, everyone thinks all fixed interest rate assets are negatively correlated and go in a certain way. But coming back to the low yields, what's happened over the last 15 years is you're starting to see investors chase high yield, sub-investment grade, a whole lot of speculative type financial instruments, which unfortunately, when things turn bad, generally these interest products go bad because they're sitting at the bottom of the cap table. So I 100% agree with you that there is a very speculative nature on some of these interests. Am I a believer, and do I agree with you that there is a chance that the traditional financial system kind of blows up and we kind of start to see government bonds go wrong? I firmly believe that central banks and governments will do absolutely everything in their power to make sure that that does not happen. And to be blunt, their powers are pretty significant. So I kind of see that. But I do start to see, but what that does is then you kind of have your third risk, which is the inflation risk. And then you need to start thinking about it in terms of nominal returns versus real returns. And that is where I see the potential of assets like Bitcoin. Because fundamentally, limited supply, it should be an inflation hedge. The big issue with that asset class at the moment is it's a lack of income, though there are products that you can get income off it. And then the volatility. It still does not have the volatility characteristics that you need to make it a safe haven asset. But I think it has the potential, to be a unique asset to protect yourself against inflation risk.
Mm-hmm. Yeah. Well, time will tell, right? Like I think we are at this weird, funky sort of transitional point where it's either going to transition or it's not. Those are really the two options. And what I'm referring to is, yeah, it's either going to get significantly worse and there's going to be a lot of significant structural changes with how we invest and how the money system works. But I don't see that happening just yet. But that's one possibility, or there's a continuation because like what you said before, Rupert, governments and central banks from all over the world will throw everything they can at this to make sure that the system keeps on going. That's kind of what they're hardwired to do, which in my mind, that spells lower interest rates ultimately for longer and all that. Although that's hard to believe right now, that's got to be the outcome because we've kind of seen the playbook already. We haven't seen a lot of creativity. We know that there's probably some stuff on the slightly more distant horizon, but that's not here yet is my gut feel. So yeah, I think you're right. Like, I think it's probably just going to be a continuation.
But you look at, Europe's a great example, right? Europe's been a mess for 15 years, ever since the global financial crisis, right? Where the Eurozone crisis lurches from one crisis to the next crisis to the next crisis. And it's amazing their ability to just keep it going and keep on ticking over, despite the fact that very few people that are there think that it actually works. And so I think, but the big one to me, which is one of the reasons why interest rates kind of have to stay low, is also you come back to the whole looking at government indebtedness, looking at household debt. It's really, really high. You look at what's happened in New Zealand over the last kind of 10 years, where we've had house prices go absolutely nuts. The days, even 5 years ago, it was unusual to find someone with $1 million mortgage, whereas today, it's hard pressed to find someone in Auckland without $1 million mortgage. And so the only way for that world to continue without causing absolute carnage on the way through is kind of low interest rates. And coming back to the housing market, I remember even the current Labor government who have kind of spent a huge amount of time talking about they want to get house prices down. Even they've been known to say that the only thing worse than rising house prices is falling house prices, which kind of leads you to kind of that there is unfortunately only one path through this. It's really high inflation and low interest rates for a very long time. Japan, they've been trying since early 2000s to get themselves out of the low interest rate environment. However, they've just never been able to generate any inflation.
Yeah. So we're being backed into a corner here, or when I say we, I guess central banks are kind of backed into the corner where inevitably it's, I'm sure there's another perspective on this, but it's starting to become quite a weak argument on the other side that interest rates can reverse from here without significant structural changes. So if we take that as a given, then inevitably as time goes on, we're going to have to start to look at what it does look and feel like when there is some sort of turning point. Yeah, I guess things can go negative. It's hard to sort of visualize that, but yeah, let's assume it could go negative, and that's fine. Would it be true though in saying though at some stage we're going to see these traditional safe havens or these traditional diversifiers as seen as speculative high risk investments? Or is it going to take some sort of disaster, some sort of meltdown where the bond market just craps itself before people start viewing it differently? Like what do you think is going to happen from here?
It depends on the different part. You got to look at the bond market in its 4 or 5 different components, right? Look, at the end of the day, central banks will protect the government bond market forever. They will just keep on printing money. They'll keep on buying bonds. The corporate bond market, I do think there's potentially a little bit of risk there. But then again, I kind of back central banks to step in for that investment grade corporate. The junk market, I mean, that is a market that had significant issues in 2008, 2009. And one of the interesting things about it is one of the interesting things about the junk bond market, about kind of financial crises, is it's very rare that you have the same financial crisis twice in a row. And so that's why I kind of go, sitting where we are now, that the debt market and the bond market doesn't feel as though that's the big issue. However, I think what this does do to me is the issue becomes exacerbated when we kind of have low interest rate yields and a high inflation environment. How long do we have that for? How long can we sustain that for? Or do we keep on bouncing in and out of low interest rates, high inflation? And I don't know how investors kind of look at that. And that if that's the world that we are looking at, then the 60-40 portfolio is definitely dead. And then I think investors will need to go and look for alternative assets where they can get that inflation protection. And to me, that is property, infrastructure. And then I think you are naive not to start looking at a lot of the cryptocurrency and alternative assets as well.
What about commodities? Does it always have to have a yield?
Yeah, no, you're right. You're 100% right. I mean, the traditional definition of a safe haven asset has been commodity, has been having a yield to support you through the downturn. But you are right. I think, and kind of there's a lot of research which says actually fundamentally commodities are that core piece that everything comes back to. And so again, they're often perform really, really well in a downturn. The issue with commodities is you've got to know when to get out, because interest they can often be seen as very leveraged plays on interest rates. A very leveraged play on inflation. And so they're great when things are going up, but they can pretty quickly turn and move backwards as well.
Yeah. Okay. Well, as we come in for a landing, let's roll out some questions here. So this one from James. So what is going to be the limit of the central bank's interest raising regime? What series of events will tell them they've gone far enough? You want to go first?
Yeah, look, I don't know what the limit is. I think that is probably the $1 trillion question that everywhere around the world is currently being asked. And so the events that are going to tell them that things have gone too far is probably it's going to come back to economic growth, right? I mean, you saw in the last quarter in the US that GDP growth was already negative. Are we going to see 2 consecutive quarters of GDP contraction? Are we going to start to see economic growth kind of fall completely away? So I think they're going to be looking really carefully at that growth data. They're going to be looking probably more closely at unemployment data and waiting to see when it all stops, right? Because that's the really hard thing, particularly now they've all got this dual mandate around inflation and interest rate, inflation and unemployment. That's the bit I think they're going to struggle with, because potentially they end up in a world of higher inflation and high employment at the same time. Stagflation, which is what bank came out with today.
Yeah, we don't like that word. I guess there's a couple of things that we can all do probably to help the central banks reach the end of their their tether with rising interest rates. We could all just stop spending money. I think we should all just band together and agree. No more going to Bunnings, no more beers on a Friday. Keep it simple. Maybe the other thing that we could do is get your parents to get back into the workforce. Just flood the market with new labor. Show what the real unemployment rate really is. Maybe that would help so that they can look at those dials that they're fixated on instead of the real economy and maybe make a decision. But from where I sit, honestly, I can see things have changed dramatically. Things probably have to get really bad. That's why I keep on thinking about this massive, deep, tick-shaped recovery where it's going to be short, hopefully, sharp, deep decline, and then a sharp, fast rebound. That's my gut feel, right? But it's got to get pretty dark. Good news is getting pretty dark out there.
Well, the big thing I kind of come back to in my mind on this one is we live in a world of hyper short cycles, and we live in a world where politicians and central bankers are now like kind of they think 3 months ahead. This kind of, I don't know when the last person thought actually a year ahead, let alone 5 or 10 years ahead. And that's why I think we've seen it. We saw it in 2009, though that was a pretty big thing that needed to be fixed. We saw it in kind of 14, 15 in the US. We saw it in 2020. We're seeing it now. They seem to be in this new world of go hard, go fast, go big. And it's kind of interesting, right? So are they going to have to do the same again here? That would be my guess, is that when the reversal happens, it'll be pretty extreme and it'll be pretty quick.
Agreed. No, that's awesome. Well, before we finish up, any parting sort of thoughts that you have on this? So from what I understand, you kind of agree that the 60-40 portfolio is officially dead. Or
so long as interest rates stay low, and I believe they'll stay low. So yes,
I agree. Okay, I'm going to keep an open mind, but I'm just going to trust whatever you say, Rupert, because I don't really know. So
don't ever do that. That's the most dangerous thing you could ever do.
I know. I'm not listening to my own advice. So what about this though? As we finish, I'm just thinking this through. I know that there's this rule of thumb: take 100 minus your age. That equals the amount that you allocate towards equities. So let's say you take 100, you're 40 years old, 60% should be equities, 40% should be bonds. So the 60-40 portfolio is really designed for a 40-year-old. And if you think about when the 60-40 kind of first started talking about, well, that 40-year-old's now pretty damn old. So it's mainly all bonds. They're paying for coming up with that idea. But when I look at, say, a typical growth policy, a growth fund within KiwiSaver, I like even the most aggressive growth fund, there's still often a little bit of bonds in there. So I guess I'm just wondering, has this been a slow moving transition towards phasing out bonds by fund managers anyway, in recognition of this?
I think there's been a recognition amongst fund managers over the last 20 years that the standard 60-40 just was not really the appropriate piece. I think with new technology, new communication, how we kind of work with our clients, we can actually do a lot better than coming up with single one-stop shop generic options. And that's fundamentally what has driven a lot of this. The reason why you still have that 5 or 10 or 15% bonds, and I think the aggressive funds in KiwiSaver land, for example, are getting more and more aggressive, is it's becoming far more interest. So you get an amazing amount of cushion for that 10% holding. But I think now that where we are in terms of what people need to retire, because you're 100% on your point, Darcy, the 60-40 portfolio came in the 70s, where you had a life expectancy of 75 and you're still expected to work till you're 65. Today, you're expected to work till you're 65, but you're going to live till you're 95. And so I think the needs are very, very different, but the communication style, the opportunity cost is also very different. So yeah, there are a lot of reasons why I don't think it actually, the more I think about it, the more it doesn't make a huge amount of sense.
No, that's cool. Awesome, everyone. Well, thanks again very much for listening in, and we'll catch you next week. How's this for a topic? Rupert? Just right off the top of my head, emotions and investing. What about that as an idea? Talk about that next week.
So the emotions is controlling our emotions is why we have our 10% allocation.
There we go.
That's why we do it. And look, I think for anyone thinking about the 60-40 portfolio, a little bit of shameless marketing, 60% equities, 40% income, assets. If you're thinking about what's right for your age, your stage, and what you're doing, go have a look on the Kura Wealth website. Put yourself in as a retirement client, and then that'll build you your very own mix, taking into account your age and your attitude to risk. This is kind of a great example of where we can use technology to deliver people a personalized outcome versus the very generic 60-40 rule.
Yeah, that's right. Like go on that. So KuraWealth.co.nz. Check out the it's pretty self-explanatory, but you don't even have to go with Kura. Just take the information and go and implement it somewhere else yourself, right? Like that's kind of pretty much what you could do.
But implement it with Kura. But at least it'll help you make informed decisions and hopefully put some of this conversation in context. Because the other thing that it will do is you can play around with the different allocations and understand what that's going to do for your final retirement balance, historical return, et cetera, et cetera.
Definitely. And remember, everyone, like this is just a very, very small sliver. You would never design your entire portfolio like this. If you have investment properties and you've got debt repayment going on or other high risk investments, you really want to be considering that whole global picture, right? So definitely get some advice on that. None of this is financial advice. I'm pretty sure we say that in the introduction, but just to be really clear, this ain't financial advice, right? Cool. Okay. Next time we'll catch you next time. The same time next week. We are talking about emotions and investing next week, though. Rupert, I'm going to remind you that close to the time. Yeah, we're going to get emotional. We're going to be crying. We're going to be sharing some tissues on Zoom. It's going to be great.
Actually, no. Let's hope by next week we're all in excitement land and we're going super excited and we're buying every single thing we can because markets have recovered.
That's right. Buy the dip, right? Another great little rule of thumb. Okay. Before we get in trouble.
Thanks, Darcy. Thanks, everyone. You too.
Cheers.